Hello and welcome. You're listening to the Investor Lab, the auditory epicenter for passionate people seeking a life of freedom, choice, and abundance. And on today's show, we talk about a very hot topic right now, Queensland land tax legislation reform, which sounds like the driest, most banal topic that we could possibly ever talk about. Who cares about that? Well, I should tell you that you should probably care about it. If you're a successful property investor or you aspire to be a successful property investor, and you are most likely going to be planning to buy in multiple states around Australia, and that would include Queensland, because diversification is a great part of a portfolio strategy. However, the government in Queensland have introduced some new legislation which has a massive impact on the potential land tax that you could pay in your portfolio. So in this episode, we unpack what that legislation is, how it actually impacts property investors. We dispel some of the myths around it. And we also talk about how you can navigate it successfully so that you don't end up burning through heaps of extra cash. So really great episode where we actually expose this situation for what it really is, cut through the noise, cut through the fear, and give you the facts on how you can continue to thrive in this current environment and ongoingly as well. So without any further ado, let's get stuck into it. And I look forward to seeing you on the inside. Hey guys, welcome back to the Investor Lab. Joining me on today's show is our resident property tax and tax in general expert, Jeremy Iannuzzelli.
Mate, you're definitely putting some big rocks and stones on my back to carry, Goose.
Totally. All right. Let's okay, well, hopefully, all good. So, mate, awesome to see you again. Got to say, a lot of people have. The last time you were on here, we were talking about SMSFs and all of that kind of stuff, and really a lot of great feedback from that. And another issue has come up recently that I thought would be great to kind of get your perspective on and get some insights from you. And it's recent changes to the Queensland land tax legislation, or proposed changes. I actually kind of want to dig into that. Are they real? Are they, all of that kind of stuff? And a lot of our clients and property investors in general have sort of been freaking out about this. They're like, am I going to get double land tax? What's going on here? Is this legal? And I just wanted to kind of take some time, have a chat with you and kind of unpack, like, what are these changes and how does it work and what's the real impact? So, mate, what's your perspective on this?
Yeah, so I will say that it is now legislated. So it has come into effect as of 1st of July 2022. Quite rushed in essence. It was discussed initially first in October of last year. Got a little bit more heated in about January of this year. And a lot of professionals, including myself, said this is never going to fly, never going to happen. But it got snuck in. It got snuck in very late June, past state legislation houses, and snuck in to be 1st of July. So essentially what Queensland state government are doing is, they've got a bit of a balance sheet issue, a bit of a cash flow problem. And they obviously need to be revoted in. That's the Labor government that's currently taking care of the Queensland state seats. So they've said, well, what can we do to not impact our votes, but also fix our balance sheet and cash flow problem? And land tax is always the one thing that many state politicians will go to because it's an easy way to hit the back pockets of the people that really can afford it, essentially. Well, that's what they say anyways. It's come in 1st of July, which means that there'll be diminishing value calculation on our Queensland land tax threshold based upon what our thresholds are, what our property land holdings are across Australia. So in essence, what they're saying is that if you only own properties in Queensland, nothing changes. It's business as usual. If you have a principal place of residence in your home state, let's say my home state is New South Wales, go the Blues, then my home is exempt, but my Queensland properties will still remain as is. Where it becomes a little bit tricky for many people is that this new land tax calculation based on land holdings around Australia is really there for people who own land or investment properties, investment land, in all states around Australia, whether it's New South Wales, Victoria, South Australia, Darwin, Northern Territory, Tasmania, and WA. So what essentially they're going to be doing is that they're going to look at your threshold in Queensland, which for an individual is 600K. They're going to be applying your total land holdings to that threshold, calculating a land tax as if all those properties were in Queensland, and then only pro-ratering what you have in Queensland versus what you have in the total country. So you'll only ever be paying land tax under this new threshold and scheme based upon your land holdings in Queensland. So there's a lot of talk out there that people are saying, oh, it's a double tax. But in this case, it isn't.
Hang on a second. You just said that it's only going to be based on your land holding in Queensland, but at the same time, it's going to be prorated based on the rest of your portfolio.
Correct.
So can we just kind of dig into that and unpack that, right? Because like pretty much everybody else, when I first heard about it, I thought it was a double land tax. So I was like, hang on a second. They're gonna make me pay land tax for on a property I've got in New South Wales as if it's in Queensland. And I'm going to end up paying land tax in New South Wales and land tax in Queensland. I was like, is this even legal? I'm still not convinced that it is really legal. I think it's the term daylight robbery in my mind has never been more true in this situation. Right?
It is, yeah. No, I agree with you 100%.
It's crazy, right? But how does that kind of proportional piece work, right? So let's say I've got $1 million worth of land value in Queensland and $1 million worth of land value in, let's just say, New South Wales, right?
Yeah. So they'll look at the total land value of Australian land, which is $2 million. Now, I think it's important to tell people that it's only based on land values. It's not based on the property value. So you might have a property value of $1 million, but the land component of that would probably only be $450,000. But for this argument's sake, we'll say $1 million.
Yeah.
They'll be calculating the land tax at $2 million. So they'll do their numbers. They'll say the land tax at $2 million.
They'll calculate the land tax threshold at $2 million, right?
So they'll take the actual amount of $2 million.
Yeah.
And they'll see where that $2 million sits inside their threshold table.
Got it.
But for argument's sake, let's say the threshold is $600,000 for an individual, which it is. And let's say the land tax on that $2 million. Now, I've actually got an example I can give you. Maybe this would work, actually.
Yeah.
I'll go with my example I've provided.
Perfect. Great. Yeah.
Go with my one. So, and the Queensland state government have come up with a couple of examples how to calculate it. So I've really ripped it off their website. So we'll use Lena in the example. Now, Lena's directly from the website. So lovely Lena. She owns a property in Queensland with a taxable value of $745,000. Now, in Queensland, our land tax threshold is $600,000. So she has exceeded that threshold by $145,000. So there will be some land tax. Now, because she's under $1 million, she gets the one-off surcharge, which is $500, and then she has to pay 1 cent in every dollar above that $600,000 threshold. So if you remember, Lena's $745 less than $600, she's got $145 exceeding threshold amount. So in that particular case, Lena would pay $1,450 on the excess, $500 as the upfront surcharge. Lena would pay $1,950. That would be her land tax under the old scheme, very normal circumstances. Now, as part of 1 July 22 changes, which will be assessed at 30 June 23, we'll take Lena's total Australian land holdings. Now, Lena has about $1.565 million worth of land in Victoria now. So Lena's done really well. She's got lots of property in Victoria, and the land value is about 1.565. So if you remember, initially I said she had 745 in Queensland. She's got another 1.565 in Victoria, taking her total land holdings to 2.3 mil. Now, the way that the Queensland state government will do the calculation is they'll say, well, we're going to look at her $2.31 million as if it was all owned in Queensland. Now, if she had $2.31 million worth of land all owned in Queensland, her land tax amount would be $26,115. That's what she would have to pay. Now, I've got many clients who are paying lots of land tax in Queensland because they've exceeded their thresholds. Now, on that $26,115, if they were to charge that, that's a double land tax. So I said at the very start, I said that Queensland it's not a double taxation, it's a proratement to actually see, well, what is the diminishing value of your land threshold? So under that scenario of the 26,115, as if all the land was owned in Queensland, we now need to prorata it. So if we go back to the start, she had 745, her total land holdings was 2.31. So the calculation is quite simple. We look at the Queensland land value, 745, divided by the total Australian land value of 2.31, times by the $26,000 calculation, remember, as if it was all calculated in Queensland. That means that Lena would pay on her $745,000 land in Queensland about $8,500 now. So where the nastiness is under the old scheme, she was paying only $2,000, and now she's paying about $8,500.
Okay, so if 30% of your portfolio is in Queensland, 40% of your portfolios in Queensland and 60% of your portfolios outside of Queensland, right?
Mm-hmm.
You would then slice it. You'd work out the total value of all of the land in your portfolio. That would determine where you sit in the threshold and subsequently what the surcharge amounts are going to be and what the tax amount is going to be. Correct. And then if only 40% of your land was actually in Queensland, you would then take the total of what that would be, divided by 40% effectively, right?
Yep.
And pay 40.
That's it.
And get the 40% piece. That is still a lot though. That is still 4 times what Leonard was going to pay.
Yeah, it's correct. Yeah. But
at least it's not 12 times.
Yeah, a lot of people got scared because they thought, oh, now I'm having to pay 26 grand of land tax. But people also forgot that the Queensland state government was purely only going to prorata it based on your Queensland land holdings. If they didn't, yes, that's a double taxation. That's wrong. That's criminal. Now, in fact, I still think it is criminal what they're doing, no doubt about it. But very similar to the way payroll tax works for Australian companies when they employ people all over the country. So they've adopted that model. And it is self-assessed because at the moment, I don't believe under legislation that the Queensland state government can go to all the other authorities and get people's independent information. So we'll see how far they go to with that.
Yeah, totally. But like your income tax is self-assessed as well, right? Pretty much in
Correct. But the thing is they're wanting people to do their own assessment on this in the sense that you'll be doing the application, you'll be telling the Queensland state government of what you own and what the land values are. Now, the question is that I asked and I spoke to OSR in Queensland. I said, well, how are you going to monitor this? How are you going to police it? Because it's not very good feeling to go and hand you guys extra money. I know I don't want to do it. So what are the repercussions? And they said, well, Jeremy, look, it's very profitable for us. So if people don't go ahead and do the application form, which mind you, there needs to be done before 31st of October 2022 or within 30 days of receiving your land tax notice of assessment, we'll catch you and we'll do it via manual. There'll be a big database and we'll be going through it. Or when you sell the property, they're working on like a land tax assessment clearance certificate. So that will either be done by, the professionals such as a solicitor or accountant to provide a letter saying this is what the client owns. So
are they talking about having any kind of penalty though?
Yes, there will be penalties. There will be penalties. There will be interest involved. And that's why they said this will become very profitable for us if people don't go ahead and do it on their own accord.
Right.
So like right now, for people who don't pay land tax, let's say they never registered with the OSR New South Wales, for instance, that's where I've seen it quite a bit. OSR will pick you up. It takes you 3, 4 or 5 years sometimes, but they do pick you up. They send you this lump sum bill of 30, 40 grand. Oh, and there's penalties and there's interest. And if you want the penalties and interest remitted, that's fine. You've got to pay it up front. But if you don't, you can go into a payment plan and the penalties and interest still apply.
What kind of interest rate are they charging?
Oh, mate, I would probably dare say a lot more than what the banks are charging. As they say to me, they're not in the interest of providing loans to people. So I can dare say that they'll charge their premium on top. Now, a couple of ways, obviously, for us to review it and understand, well, how do we work around it? We've come up with a number of ways, and it comes back to their legislation. So there are some excluded lands, of course. So like many other states, your principal place of residence is excluded from this calculation, which is great. Primary production land, so land that is held for the use of business on agriculture, that's excluded. Retirement villages, aged cares, charitable institutions, movable dwellings such as a caravan park, and supported accommodation. So that would include potentially some boarding houses as well.
So caravan parks are excluded.
Yeah, caravan parks would be movable dwelling parks. So that's like a caravan.
Yeah. Or like, the kind of the classic like trailer park type
of things. That's right. And as I said, retirement villages and charitable aged. The big one's primary production and the supported accommodation. That's your like low-income housing scheme, boarding house style of investments. So there are a couple of lands that are excluded from it. But what we've done as accountants is we've really spoken to them and nailed it down. And we said, well, how about if they own the property in their wife's name or they own their property in a trust? They're only looking on a per entity basis. So if you've gone ahead and bought all your properties 50-50, that won't help. But if you've got properties in your name, properties in your wife's name or husband's name, or properties in a trust, they're only looking on an entity basis threshold. So a lot of people let's dig into that. That sounds like that's awesome. So let's talk about the trust piece. So like, are you talking about
buying individual, just like to kind of take it to a kind of an extreme level to paint the picture. You're talking about individual trusts for each property you purchase in Queensland, or would you talk about, for example, and obviously I'm not giving any advice and all of that normal kind of stuff, like putting all of your Queensland properties in one entity, but then all of your New South Wales properties in another? Like, what do you think? What's the thinking there? Let's talk about that.
So that's a great, you've hit the nail on the head. So they have got some clone trust ruling that they're going through at the moment. Now, clone trust ruling is they're trying to stop people just establishing a new trust for every property and avoiding land tax. No doubt about it. But again, if you've already exceeded the threshold in your own names, either husband and wife together 50-50 or in your own name separately, then yes, having a trust, say for instance in Queensland, would create a new threshold of 350K, buying in that. And that way, that means you would only ever be paying a true amount of land tax on your Queensland-based properties. And you would not want to put any other properties in that Queensland trust, such as properties in WA or properties in New South Wales or Victoria, because that would only increase your threshold increment, which would therefore increase the amount of land tax one would pay. So there's a lot of planning now as accountants that we need to consider, well, where someone wasn't ready for a trust just yet, they may be now, number one. And number two, we may isolate that trust depending on what the clone trust rules come out to say. We might isolate that trust to only owning Queensland properties and not put any South Australian, WA, New South Wales, Victorian, Tasmanian, Northern Territory or Canberrian properties. And the reason for that is we don't want to, as I said, increment ourselves into a new threshold where a new calculation and percentage is paid.
Oh, that sounds like a pretty easy way around it then.
Yeah,
really.
It is. And now it's just planning. Now it's just making sure that, again, you're working very closely with, say, your accountant or solicitor and giving them an outline of goals. And, you know, as people work with you guys at Dashdot, making sure that they're getting the amount of properties they want to buy based on their portfolio goals and objectives. My role is to say, well, go out and buy it, and I'll make sure that we quarantine it so all the regulatory authorities aren't getting too much more money than what they're supposed to.
Yeah, totally. Okay, that's cool. That's kind of like taking a lot of the fear out of it, really, right? Because a lot of people, number one, just thought it was going to be a blanket, double land tax, and they're going to be stuck with it. But if there's, obviously, it's not a double land tax, it's proportionate. And in fact,
correct,
if you think about your portfolio strategically, which everyone should be doing, as opposed to just randomly buying properties ad hoc with no clear plan around future planning and structuring and what does that look like. If you do all of that kind of stuff and plan your portfolio out, then it sounds like you can kind of. There's obviously some other significant advantages in some kind of trust structuring stuff as well when it comes to finance. So it could actually work out to be a good thing.
Yeah, and look, there is always a silver lining. There's definitely always a silver lining. So some people, as you know, they may not have wanted to jump into a trust soon because they didn't really feel that the cost versus benefit analysis was there. But in the long term, I've always seen costs far outweigh what an individual ownership would be. It's just compensating and understanding and the comparable around the cost and what that cost brings in the future benefit. But yeah, no, there's lots of benefits towards it. And this is a way now that we can help mitigate this particular legislation that's come in, and obviously how we move forward with that may assist the client moving forward with future goals, because a lot of people, will use trust for one reason, where it's asset protection or potentially tax minimization, but used in the right way, especially with the right broker and the right bank. If you can get that trust into a positive position as quick as you can, there are some banks out there that will say, well, it's been able to meet its own commitments without further capital required from the beneficiaries or the trustees, and that would essentially disregard that debt for future borrowing capacity. So there are lots of positives, and I always tell people, I've been able to build my portfolio where it is today on the basis of having lots of positive geared properties in entities, able to meet their own commitments without any further capital injected by myself. And that way it gives me an opportunity to continue to grow and borrow, because they're not taking, some banks are not taking that debt obligation or that debt that I've got into consideration for future borrowing capacity.
Yeah, awesome. It's kind of like the secret hack to infinite finance. You just got to really got to understand how to play. Maybe not infinite, it's probably got a little far, but but it's definitely a good opportunity. Let's talk about the impact on the Queensland real estate market, because some people will have the opportunity, the insights and all that kind of stuff to set up trusts and do all of this kind of stuff, and might be able to avoid maybe not any impact from these new this new legislation, but might be a lot of impact. but some people won't, right? Do you think that this is going to have an impact on the Queensland property market? Do you think this is going to, how do you think this is going to change the dynamic? Because when you do have something that comes into place, which is going to increase nominal costs on a property or a property portfolio by maybe 4 times, like in terms of land tax, what do you think? Do you think it's going to have any? Because some of the concern or the fear is that property investors will stop buying in Queensland and the whole market's going to go to shit, which quite frankly, I don't believe. But what's your take on it?
Yeah, it's the fear of the unknown for many people. So I think as they start to educate themselves more on what it actually means, most people will find out that it's not that bad. Now, for some people, like Lena, unfortunately, there is a $6,500 difference for her. But she's got $2.31 million worth of land value and probably $5-6 million worth of capital value. So if you take that $6,500 based upon her total value of property, it's very small.
Yeah.
So it's nothing to really panic about. Yes, it's unfortunate. Yes, it's cruel. Yes, I think it's highway robbery, to use your words, which I agree with. But I don't believe it's going to have the impact that many people think. If anything, what you'll find is a lot of this additional costs will be passed on through the rent. And why do I know this? Because they tried to get rid of negative gearing in the late 80s, and all it did was push up rents even higher to a point where they said, well, we've got to bring these rents down. It's only increasing to inflation pressures. So they'll tend to take a step back. I don't think the state government will do that as quick. I still believe that they've got a hole to plug and they don't want to lose votes. So this is an opportunity for them to do it. But I truly believe this will be passed through rents, because if everyone's cost incrementally goes up, it will be passed on, and the tenants, unfortunately, will be the ones left paying the bill. So I don't think you'll find many people will struggle. And if your portfolio struggles on additional $2,000 worth of costs, I think you've got to really have a look at your portfolio and see what's happening.
Yeah. Look, it's not to discount the impact that $2,000 of additional costs can have on a family, and all of that kind of stuff. Like that's, it's not insignificant. It's still money that people need to find. And, the cost of living's going up and all of that kind of stuff. And what can sometimes happen in these conversations is that people like you and I can get a little blasé and be like, look, it's only $2,000 and whatever. But for some people, that's a major thing. And that's not, I'm not trying to paint a picture of kind of like, woe is them or whatever. But I remember only a few years ago when I had nothing, and was literally living in my office for $2,000. Somebody said you're going to have an extra $2,000 a year in costs. I would have been mortified, right? And so it can make a big difference depending on where you're at in your journey and also what your other expenses are and all that kind of stuff. But right, and not to discount that reality for some people, right? Which hopefully by building a strategic portfolio, you can actually start to get out of that cycle, and you can start to, bring in what you need. But also it's about perspective, I think, perspective on what those numbers really mean. Because, the way that I see it, let's say you do end up with a few extra $1,000 of cost in your portfolio, not discounting the impact that can have on cash and what that means for an individual, that can have a significant impact. But also, if your property, let's say, or if your portfolio in this case, because it sounds like Lena in this example has probably got a few properties to have that much land value in Queensland, or whatever it is, your portfolio might be making you, in terms of a combined amount of growth and total return and all of this other kind of stuff, 30, 40, 50 grand a year, right? And so you might have nominal increase of cost of, say, $4,000 or whatever the case may be. But also look at the big picture, right? And so you've got to look at what the actual total return basis is that you're getting and all that kind of stuff. Because otherwise I think people can, focus on the wrong things and make decisions based off the wrong levers in their portfolio. Yeah,
and look, it's a cost. It will be a cost of doing business, like anything. Like tax is a cost of doing business. You want positive income. There is tax that definitely comes with it. Structured the right way, we can reduce it, but nevertheless, we can't have $100,000 income and the tax always being zero every year. There will be a point in time where there is tax. It's just a cost of generally doing business. So I think the big thing for many people to understand is, yes, we all know it's crap, it's highway robbery, but it shouldn't be the be all and end all of the portfolio. I look through a lot of where incomes are versus property valuations and property median prices, and Queensland still, without a doubt, is below that standard bank's assessment of 6 times your income. So they call it debt to income ratio, and most of the states like New South Wales and Victoria are well over that 6 times. But say Queensland, for instance, is a state where it's under 6 times debt to income. So there's still a lot of fat there in Queensland. So for anyone that thinks that Queensland's going to bust and the bubble's going to burst on the basis of this land tax, I would dare say probably don't be praying and wishing that to happen.
Yeah.
I think you'll find that there will be some rent increases to help compensate this difference. As I said, it will affect some people, but not all people. If all you've got is property in Queensland, it's business as usual. If you've only got a small amount of property outside of Queensland, it should only impact you very slightly. But for people holding larger portfolios with this not being grandfathered, yeah, you will see a difference in the land tax that you will pay. But I suppose it gives you an opportunity to pivot and look in a different direction where you can support that additional cost with some properties in the future from a better performing cash flow perspective.
Yeah.
And also some properties in the future in a better structure so that you're not adding to the problem.
Yeah,
and
totally.
I think that's the main thing.
And that's a really interesting point that you just made. And this is something that we're looking at with our clients right now because, the macro environment has changed right now. Interest rates have gone up. That affects nominal cash flows. And, there are these real impacts that we need to consider in the portfolio. And so strategically thinking about okay, what do I need to do to offset some of these costs? I don't know, maybe specifically for the next property, purchase an asset which is going to produce enough net cash flow to be able to offset that kind of stuff. You know what I mean? And so thinking about from a portfolio perspective, what types of assets, so rather than going, oh my God, this doesn't make sense, I'm now negative by whatever, $5,000 a year, help. Just go, okay, well, what would I need to do to make up that $5,000 a year? Could I buy a different asset, which is going to produce a different outcome, which will compensate that and kind of put me back on a, right side the portfolio in a sense, right? So, and I think that that's a really good mindset for people to be kind of approaching any of this kind of stuff with. It's not like, help. It's more like, okay, well, what do I need to do to make this something that I don't care about anymore?
Yeah, and I always encourage people to treat their portfolio like a business. If you've got a business that's got a lot of cost, well, one way we can do things is increase the income or we can decrease the costs. Sometimes it's a bit hard to decrease the cost, so we've got to look at ways to increase the income. So I encourage everybody and always tell everyone, treat your portfolio like a business. The more that you can really assess the way things are, the more strategic you can be with your future decisions and you'll win from it. If you really put the time and effort in, you'll win from it. And, again, strategically buying the next property to compensate what you've bought or to prepare yourself for what you will buy, that's always obviously important as well. And I've done that within my own portfolio. I've bought some really good capital growth assets, which have done exceptionally well, but the cash flow is terrible. The way I've compensated that is I've went and bought 3, say, cheaper properties, exorbitant cash flows to help manage that one big whale that I've got. And all of a sudden I've balanced the books. So that's probably one thing I always recommend to people is find ways that you can balance the books. And in your words, you use the word pivot. And that's so important. You've got to be able to pivot, and especially coming from your structure, your strategy, and then what's the next property to buy to get that pivot right.
Yeah, couldn't agree more. Well, Jeremy, mate, I reckon we kind of nailed this. I think that's we've really ripped back the curtain and, shown the situation for what it is. And it's not as bad and as scary as everyone kind of thought. So I think let's maybe leave it there. It's been awesome.
It's been a pleasure as always, Goose.
Mate, great to have you again on the show. Look forward to next time and thanks again. See you soon.
Love it, mate. Thank you.